Hello, welcome back, and let's talk about the stochastic indicator, how to use it, what is its functionality, and how to apply it to your charts to find the best trading opportunities. So let's briefly start with what is the stochastic. It's an oscillator. It analyzes momentum and trend strength. And more importantly, when we look at how the stochastic is formulated and how the calculation works, it shows how strong the market pushes in a certain direction. This is very, very important. Always keep that in mind. And what this means when we look at a chart, we can see it right here. So let's assume we have the stochastic set to a 5-period setting. Then it will analyze 5 or 6 candles. So I think in this example we have 1, 2, 3, 4, 5, 6 candles. All right, so let's say it's set to 6 periods. What it does is that it looks at the low of the 6 candles and it looks at the high, and then it looks at where did the price close. So here you can see from 60 to 100, that's the price range of the 6 candles, and the market closed almost at the absolute high of this range. So the stochastic will be very, very high because obviously it closed almost at the top of the range. And that's why I said it's so important to always remember when you use the stochastic, ask yourself, how strong is the price pushing in a certain direction? In this example, it's pushing very, very strongly in a certain direction. Here, the opposite. So from here to here, the high of this range was 80, the low of the range is 50, and the market closed at 55. So it closed almost at the lowest low of this range. So the market is very strongly pushing into the lows. And the stochastic shows us a value of 17, which confirms that obviously the market is pushing very, very strongly into one direction. And now let's apply this to our charts and see how to use it. The most important thing to realize is that the stochastic indicator cannot be used using overbought and oversold to time reversal trends, because the stochastic does the exactly opposite thing. When the stochastic is going higher, it shows you that the market is also going higher. So don't go against the stochastic. It violates what the stochastic is doing. You can use the stochastic, as I will show you later, to find reversal trades with divergences, but not in this example. Here, going against overbought and oversold, which are terms that are completely random and are made up, will lead to you losing money. This is almost a guarantee. You can't see how long did the market go up, how long did the market go down, even though the stochastic was oversold and overbought here. Another example. This is very important to realize, and I've talked about this so many times, still many traders get this wrong. Don't go against your stochastic. Yes, it is an overbought, but overbought, what does it mean? It means that the market is very, very strongly pushing in a certain direction. And here as well, the same applies. The stochastic can also be used for breakout trading very effectively. So when your market, or when any market is contracting, it's in a consolidation. You can see here the consolidation is getting smaller and smaller, feels like a wedge pattern, and the stochastic will show you the same. There's no direction. The market is just moving up and down within small waves. And then what you do is you just wait for a breakout of the range. You wait for a breakout out of your stochastic. You could have even drawn here a horizontal level, and then you can time your trades. And as long as the stochastic is going up, even if it's entering overbought, you stay in your trade, because this is what the stochastic is telling you. Obviously, you can build a whole trading idea or a whole trading system around it, and this is just one component, but this is how you could use it. Here, another example. And this is actually how you use the stochastic to find when the market is turning. Those are the so-called divergences. I've talked about them in my RSI video, in the MACD video, and in stochastic we can use it as well. What does the divergence tell us? It tells us that the price action and the indicator, they are doing different things. So here in this example, the market did show a lower low, but the indicator showed us a higher low. Why? Because comparing this trend wave to the second trend wave obviously shows that the second trend wave was much weaker. It's not as long and not as strong. So it shows us and it tells us that heads up, the market is losing strength. And here the same. The market was making higher highs, but the indicator already told us and showed us that, wait a moment, be careful, the last trend waves are not as strong and the market is losing strength. And we can do that as well when we look at live charts. So here is a recent example of the British pound yen. And again, here we have a divergence. You can see that. The market was making higher highs and higher lows, and the indicator is making lower lows or lower highs. Very important, don't go against your price action. Your price action still shows you that the market is going higher highs and higher lows. Very important. Don't go against it. But also note that what is the price action showing? It's not going higher as easily anymore. And the stochastic just confirms that. Again, the stochastic is an indicator. And as the name suggests, it just indicates something. It's not meant to be used as a standalone system. Build other things around it or use other tools to make the system and the signal more robust. We can take a look at a different example. So here I picked two divergences that are very nice examples. So the market was in a downtrend, as shows the stochastic here. And then even though the market was making lower lows, you can already see that clearly this area here was not as strong as what led into this downtrend in the first place. So you can see, okay, this is much weaker than this one compared to this one. So here we don't have as much selling pressure, and the stochastic confirms it. It says the market is not pushing into the lows as strongly anymore, so heads up. And what happened afterwards? The market reversed. Here another example, the market was moving lower and lower, but the stochastic showed us, wait a moment, it's not as strong anymore. The bears are not as interested anymore. And then you can see the downtrend stop for a moment. Of course, nothing will work 100% of the time. You cannot always expect a complete market turnaround, but it can also be used to time exits and to manage your, or to just control your trade management. A final recent example, you can see here the market was in a clear uptrend. The stochastic was going higher and higher, but then here at the top, the stochastic confirmed now the uptrend is not as strong anymore, and get ready for a downtrend or maybe a reversal, which then happened. It's still going on, and you can see that with the help of the stochastic divergence, you could have anticipated it. Not always will you be able to pick the absolute reversal point, but the stochastic will show you very precisely when a market is gaining strength and when it's losing strength. Very important to conclude the video. The stochastic, as I said, is a momentum indicator, so it's best used for trends. When you enter a range market, the stochastic will lose its functionality a little bit. It will just get wiggly and crisscross all the time, and then you stay away from it. You can wait for a clear breakout, which happened then here. You can see that the market has here some type of wedge or triangle or whatever pattern here. And then once the market breaks out, then the stochastic becomes useful again. You can use it to stay in your trade. And then once the divergence is confirmed and the market rolls over, it's time to get out. And that's it, how you can understand the stochastic in a much better way.